Do you ever feel in the back of your head, like deep down inside of you, you need to start investing, but you don't even know how or where to even start? I felt the exact same way when I started working and I was making a good amount of money, and I realized that I actually needed to start investing some of that. I found a simple 3-step process to start your very first investment as a beginner. So let's get into it. I started my very first investment about 7 years ago now, and it took a lot of trial and errors and learning and relearning to discover what I'm about to share with you guys here in this video for free. The very first step is to ask yourself this question: what is my risk appetite or my risk tolerance? Risk appetite is the amount of risk you're willing to take or accept in order to achieve your goals or objectives. If your goal is to make 1 million in the next 1 month or the next 1 year, what are you willing to risk to achieve that? Knowing your risk appetite will guide you towards knowing what kind of investments you need to be investing in as an individual and what kind of investments you need to be avoiding. I personally know that I have a low risk appetite, which is why I typically avoid risky investments. If, for example, you're given 1,000 and you're told at the end of the month you'd be giving 20% on top of that, with your capital guaranteed, and then the second option is you're giving 1,000 and at the end of the month you're going to be making another 1,000 on top, but your capital is not guaranteed. Which of the options do you think someone like me with a low risk appetite is going to be going for? Of course, I'm going to be going for the first option because I want to ensure that my capital is safe, my capital is guaranteed, because obviously I know that I have a low risk appetite. I wouldn't want to lose my capital. But someone with a higher risk appetite will be willing to risk it all, will be willing to risk their capital and say, yes, I'm willing to take the chance that, if it succeeds, I get to make an extra 1,000 on top of my 1,000. So that's just an example to put things in perspective for you. If you don't know your risk tolerance, you would end up losing money because you're just simply going to be investing based off on someone else is doing it, rather than assessing yourself and assessing your situation and investing based on your risk tolerance. When I just go into investing, I usually hear a lot of people talk about stocks, how they get dividend from stocks, and then there's also their capital appreciating as well, how much they make from stocks. If you invest a little amount, you're getting these huge amounts maybe after like a year or 2 years of holding on to those shares or stocks that you buy from a company. I'm just hearing people say they invest in stocks and they make so much money. I knew like that was literally the only investment I wanted to do, because I thought stocks was literally the only way to go. So I pretty much thought stocks was going to make me rich. Stocks were going to make me a millionaire from literally nothing, based off on the reviews and the opinions of other people's experiences that they've shared online and even in person with me. But if I had just blindly jumped into it, investing in stocks based off on the fact that other people have shared what they've earned or how much they made from stocks, I would have ended up losing, because at the end of the day, I know that I don't have a high risk appetite to invest in stocks, because we all know that stocks can either go up or it can either go down. If a company goes bankrupt, then you end up losing it all. Okay, so someone with a low risk appetite or low risk tolerance has no business investing in shares, and that is why this first step is very crucial for any beginner that wants to get into investing. Now, the second step is to know what to invest in. You cannot invest if you don't even know what options you have to invest. I'm going to divide this into 3: low risk, medium risk, and then high risk investment options. Low risk investments are safer and they have lower returns. The example of these are high yield savings accounts, fixed deposits. For fixed deposits, here your capital is protected while you earn interest on that capital. So you could either do this online or with a local bank. I personally have a fixed deposit, but I'm doing mine online, not with a local bank, and I'm earning 22% on my fixed deposits, which I think is quite a good amount of money to earn, as opposed to leaving my money in the bank. And another option for the low risk investment is the money market fund. So how this works is investors pool their money together, and the funds manager then takes that money and invests it on their behalf on a highly liquid instrument or security, which will then which, when it yields interest, will then be shared amongst the investors. The advantage of this is you can negotiate better interest rates as opposed to investing as an individual. When you pool your money together, you pretty much have more bargaining power. You're pretty much like an organization where you can negotiate better for yourself, as opposed to if you're investing as an individual. And another advantage of this is that you have easy access to your money, because they usually invest in instruments that are highly liquid. Now let's head on to medium risk investments. An example of medium risk investments is dividends. Now dividends is where you get paid from investing in company stocks or shares. Investing in stocks is when you buy shares of a company, which simply means you own part of that company. If you own shares in Apple, for instance, you own part of Apple. How do you make money from shares? There are two ways of making money from shares: through dividends and through capital appreciation. I'll give an example. If Apple was worth 1,000 and you have 1% of Apple, that means you have one, right? And let's say a few years go by or a few months go by and Apple then appreciates to 2,000. That 1% that you had would now become 2. Now the difference between the previous amount and the amount that it is now is capital gains. If you decide to sell it off now, the difference or the profit you make from selling that share is called capital gains. Now that's the first way. The second way to make money from shares is through dividends. Some companies pay out part of their profit to their shareholders in form of dividend, and that is the second way you make money from owning shares. The benefit of this is that you gain through two ways: through dividends and through capital appreciation. And the risk is that your shares, or rather the value of your shares, could either go up or go down. And remember, like I said, if a company goes bankrupt, you lose all your money. This is why it's best to invest in blue chip companies known for consistent dividend payouts, such as Coca-Cola or P&G, Procter & Gamble. Now we're going to move on to high risk investments. Now from the name you can tell that these have a higher risk, and they also have higher returns. The higher the risk, the higher the return. The lower the risk, the lower the returns. Okay, so the first example is cryptocurrency. You could invest in cryptocurrency like Bitcoin or digital assets like NFTs. But bear in mind that these can fluctuate, which makes them very risky. The second risk investment is startups. So you could invest in early startups through crowdfunding and platforms like Seed Invest. And the payout for investing in early startups is quite substantial if it's successful, and if it fails, then you obviously lose all of your investments. And also the failure rate of startups is also quite high, which is why it's on the risky side of the risk tolerance scale for investments. Another example of high risk investments is also Tesla. Now we all know that Tesla is very innovative, and also with companies that are very innovative and new like Tesla is, it also means that it can be very volatile. So you can invest in companies that are innovative just like Tesla, and again it's the same thing. If it succeeds, the payoff is quite substantial, and then if it fails, you obviously stand to lose. And that's how it is with investment, or when you're investing in things that are highly innovative, things that are new. It could go either way. It could either be successful or it could fail. But either way, it's a risk that you're willing to bear if you're, on the high risk tolerance side of things. I really hope at this point I'm not overwhelming you as a beginner. I'm just trying to inform you or bring to you the information that I've pretty much learned on my own over the years. So at this point, we've pretty much understood risk tolerance and the different kind of investments we can invest in based off on our risk tolerance levels. Now we're going to move into the third step, which is the actual investment, or to actually start investing your money. I think it's a great idea to actually start small, especially as a beginner. I believe everyone needs to test the water, even if you feel like you literally don't know what to invest in first or what your risk appetite is. I believe everyone should start small. If it's literally 5,000 that you have, start with 5,000, and if it's like $100 that you have, start with $100. Like literally no amount is too small to start investing with, because I believe by just testing the waters or starting small, you're gaining knowledge. Two, if you end up failing or if you end up losing the money, you learn from it. And if you end up succeeding, well, you win extra cash. But the point is to literally just start. We always have excuses and reasons why we can't start yet. Oh, I don't know how to start. Oh, I'm a beginner. Oh, I've actually tried before and then I lost money. Well, with this video, you're in a better off position to actually start investing today. What more information do you need? I feel like a lot of the times you just feel like we need more information to be ready. We need to know more. We need this. And I've found with life that a lot of times, a lot of the things we feel like we need, we don't actually need that. It's just literally start with wherever you are, whatever you have, just start at that point. And I just want to mention that you can also diversify your portfolio. You don't have to have just low risk investments or just high risk investments. You can actually have a mix of, 2 or 3 out of that. I personally like to diversify. I usually would invest in fixed deposits. I also invest in my local currency. I invest in dollars as well. So like I said, I like to diversify my investments. So guys, we've come to the end of the video. Let me know if this video was helpful for you, if you learned something new, or if there's anything else you have to share with us. Please leave that in the comment section below, and I'll see you all in my next video. Bye.